corporations obtain permanent capital from owners? They sell them stock. How does that work? Corporations get cash in exchange for a legal document showing that they're owners, they have the right to vote, and they have the right to some dividends if they're ever declared. There are two kinds of stock, preferred stock and common stock, and they can have different features. You can see those features in your text on those pages. You're going to be responsible for the cumulative feature of preferred stock, but not the other ones. And then, of course, common stock. Let's look at preferred stock. It has special privileges that common stock does not have. They can get dividends before the common shareholders, and they get a certain dividend a year. For instance, a 5% $20 par value is going to get $1 per share. The 9% $50, $4.50 a share. If you have a cumulative preferred, then they have to make up any missed dividends before the common shareholders get anything. If there's a missed dividend, it's called in arrears. Now, there's no obligation to cure arrears. You just can't pay any common shareholders until you do. What's par value? That's the legal minimum capital, and it's kept in a separate account. If you get more than the legal minimum when you issue it, you put it in a separate account. Let's look at this. Issue 10,000 shares, $1 par value, but you got $15 for it. Okay, you've got to put $1 per share, that's the par value, in a separate account from the funds you got in excess of par, which was the $14. It's possible to have a no par value stock. In some states that's permitted, in which case you can put the whole $15 in one account and you don't have to split out the par separate from the paid-in capital in excess of par. It's a little easier, but it may not be something you can do if you have a par stock. You got to split it out. What's a stock split? That's when a corporation issues a large number of shares in exchange for the shares that are already outstanding. A typical one might be 2 for 1 or 3 for 1, so 2 shares for each one you have or 3 shares for each one you have. It changes the par value and the number of shares outstanding. Let's look at this. Let's have a 2 for 1 stock split. What happens to the common stock? The par went down and the number of shares went up, and that's it. No owners own any more of the company. No assets were sent out. Not too much changed. A little bit different with a stock dividend. Here we are distributing additional shares, typically not nearly as many as in a split. But we're going to reduce retained earnings and move it into the paid-in capital account. Let's see how this is done. 10% stock dividend when the stock was trading at $17. All right, 10%, how many shares would that be? That'd be 1,000 shares, $17 a share. We would move 17,000 out of retained earnings up into paid-in capital. It kind of hides retained earnings into permanent capital. Some companies like that. Let's try a problem. Freeze this frame, look at these details, and see if you can't craft what the equity section of the balance sheet looks like. What's total equity? Did you get this? Let's look at the calculations. There's the calculations of the first 3, separating out the par from excess of par. Okay, let's look at the last 2. Those are the hardest ones. You've got the excess of par, plus you've got that stock dividend that was reclassified from retained earnings up into paid-in capital. Try another. Freeze this frame. See if you can figure out, do it before and after the stock dividend so you can get a real close look at that. Here it is before the stock dividend. All right, let's look at it after the stock dividend now. That's right, you had to move $4,400 from retained earnings and put it up in paid-in capital in order to show the effect of the stock dividend. Notice total equity did not change. Why didn't it change? You can look back to the prior screen if you want. Because all we did was rearrange furniture within the equity section of the balance sheet. We didn't change any assets. We didn't change any liabilities. Treasury stock. This is when a company repurchases their own stock in the open market. It's essentially the reverse of issuing stock. You're giving back permanent capital to owners, and you're getting their certificate back from them. It's the reverse of issuing stock. When we buy back treasury stock, however, we don't typically cancel it. We leave it in permanent capital and show it as a minus in our equity section. Let's see what that might look like for a particular company. Here's a particular company, and they have preferred and common stock, and they have repurchased 1,000 shares of common stock. It's a reduction of the total capital that they've gotten. Outstanding stock, what's that? Authorized shares, the amount that they could issue. Issued shares, the amount they actually have issued. And outstanding shares are issued less any shares in Treasury, your Treasury stock. All right, can you calculate the number of shares issued outstanding? What if issued and outstanding are the same? Is there Treasury stock? Freeze and see. There you go. So if Treasury stock does not exist, issued and outstanding are the same.